First of all, good morning, everyone. Like you heard, my name is Pedro, and I kind of want to say thank you all for still being here on day 3 of the conference. I know everyone's heard lots of deep and interesting topics over the last few days, and I really appreciate you're still here to give your attention now to me. I work at a company called Jane Street. I'll talk a little bit more about what we do, but it's not the main purpose of the talk actually. I want to talk more about tech. But what we do is that we trade financial products in markets around the world. And what that means is stocks, options, bonds, all the sorts of things you can imagine trading in financial markets. I promise you will not need any finance knowledge to follow the talk. You also don't need any, I also barely have any finance knowledge when I started there. Now I have some. I want to use my 35 minutes here to give you an overview of how we think about production engineering in this kind of environment, and also how we think about reliability in general. Before I talk a little bit more about myself and go into the details of the talk and how we build and monitor trading systems, I want to start by telling you a story of a real-world event that happened. Who here has heard of Night Day or a company called Night Capital? Well, that's not bad, it's about half. For those of you who don't know, I'm going to recap the story. For those of you who do know, maybe I'll go into a little bit more detail and some of the takeaways that we've had from this particular event. So in 2012, there was a company called Night Capital. Night Capital was one of the largest US trading companies at the time. They made up a very significant proportion of the trading on, for example, the New York Stock Exchange. As part of that, they were obviously using heavily automated trading systems. Now, on August 1st of 2012, they tried to deploy an updated version of one of their trading systems into production. In the old version of their particular system, there was a piece of code that had been unused for a while, a few years, and thus hadn't been maintained properly. It has now picked up a couple of bugs, but it didn't matter because the particular instruction to enable that piece of code was entirely unused. In the new version now, they repurposed that particular instruction to point at a new piece of code that they wanted to turn on to enable a new kind of trading that they were excited to get into. And now this happened. When they upgraded their systems on August 1st of 2012, one of their suite of trading systems, one of those systems, failed to upgrade and remained at the old version. When trading now started at 9:30 a.m. Eastern, this one unupgraded system started executing this old code that I mentioned had picked up bugs, was deprecated, and in general poorly understood. Within the next 45 minutes, after trading had opened at 9:30, the company lost $460 million. It was a major disruption to the prices of companies on the New York Stock Exchange. More than 390 million shares of companies were traded, and the firm acquired several $1 billion worth of positions, kind of like accumulated trades in that sense, that they did not want and didn't intend to do. In the aftermath of those 45 minutes of that incident on that day, Night Capital's own stock price collapsed, and roughly 4 months later, they were bought out by a competitor. Now, there are lots of nuances to this particular incident, and I left them out now, and they're really interesting to read up. If you're particularly interested, I'll put up some links in a minute, and you'll see them on the slides to the SEC, to the Securities and Exchange Commission, how they've analyzed this particular incident. It is a great read. I think there are some interesting takeaways there. And there are some obvious things that went wrong here, we might say now, in hindsight. People made software engineering mistakes, and it's easy to label them as obvious mistakes, but I also think they were quite honest mistakes. Probably all of us have cut corners at some point in the development cycle. For example, having left around some dead code because you thought I might use it later, and had left it around for longer than it should have been. All of us have probably done that in the past. Or repurposed some config field or some kind of parameter because you didn't want to deal with a version upgrade or you didn't want to deal with that sort of migration. I'm pretty sure most of us can relate to that. However, I still think there are a couple of non-software engineering takeaways from this that relate to production engineering, what we would call at Jane Street and the general attitude around support. 4 I want to highlight. The first and maybe most important one is that trading is really, really scary. If you haven't thought about it, like if you don't think trading is scary, you probably haven't thought about it hard enough. In 45 minutes, you can very easily burn over $460 million of your own capital. And that's dollars in 2012 terms. I don't even want to do the math of how much it is today. That is over $10 million per minute that you're burning. Robust and redundant monitoring is crucial in this kind of environment. It's not that the people at Knight Capital didn't have monitoring. They were smart engineers. They did have systems to monitor what kind of trading was going on. For example, in this case, they did have a system that would track the kind of positions that they would accumulate. So as you buy, you incrementally increase your position in a particular stock, for example. However, due to the increased load of the system executing trades over and over again, that monitoring system itself started falling behind and couldn't keep up with the volume that was happening. Your monitoring system might fail when you most need it. Noisy alerts are worse than useless. On that morning, there were 97 emails that went out about that unupgraded system before trading had opened. It is not clear why no one reacted to these or how exactly they reacted to them. But the fact that there was 97 of them probably points at something here that people might have been desensitized to these kind of alerts. They thought, this is just another thing that happened over here. It's not actionable. Having clear, actionable alerts could have saved this, and people would have noticed before the market opened. We would have never heard about this incident. And the fourth thing that we took away from this as well is you want to empower your support to actually take action in these situations. If within 5 minutes, someone from their support team would have realized the magnitude of what's happening, the potential risks, and then been able to take a step to shut down trading, or in particular the system, things would have still been bad. They would have lost a lot of money, but it wouldn't have taken down the company probably. It wouldn't have been in the news, and I certainly wouldn't be talking about it today. These are the links up there, very interesting. Highly recommend having a read later on. You can just look for Knight Capital on Google and you'll find these. So today I want to talk about how we as Jane Street, a company in a very similar business, or kind of the same business basically, how we build systems and practices that we do not run into these kinds of issues that lose a lot of money in a very short amount of time. I want to talk about how do we monitor our systems, how do we respond to incidents, and how in general do we work to improve the quality of our infrastructure. I'll roughly go through it in 3 sections. First, I want to talk a bit about how trading looks like in general, what kind of tech we build at a high level, what things matter in trading. Second, I want to talk about how we approach monitoring and support. And lastly, I want to spend a little bit amount of time also talking about project work, so kind of systems that production engineers and software engineers develop together in order to enable us to respond well to these sort of incidents. Now, a couple more words about myself. So you actually know who I am. So I'm a software engineer. I've been at Jane Street for over 7 years. Before that time, I spent some time working in Berlin at kind of a web startup. This is also where I'm from. Actually, before that, spent a year in the Bay Area. This is my first time being back since 2014. I'm pretty damn excited about it. Now I live in London, in the UK, which is very different and a very different life. And I think in the past 4 days here, I've seen more sun than I've seen like in the last 6 months. In London, which is, I don't know, a different feeling that vitamin D is hitting pretty hard. But anyways, that's like neither here nor there. Jane Street is a proprietary trading company. And roughly what that means is that we trade with our own money on financial markets. We do it with our own capital, our own strategies, and our own technologies. A lot of things we build are built in-house, optimized for our use cases. And because of that sort of structure, we are very clearly and directly responsible to build our tech in a way that doesn't end up losing all of our own money. It's not customer money that we're losing, it is our own money that we will be losing. So let's talk about what a trading environment looks like at a high level. So you have a trader who wants to trade on a market. I'm going to pick NASDAQ, but you can pick any market in the world. There are roughly 3 components at a high level that I'm going to mention that you want. One, the first thing you might want is something we call market data. So the trader wants to have some visibility about what's happening in the market. We also call this like tick data. What kind of orders are happening in the market, who currently wants to buy, who currently wants to sell something, what kind of trades are happening. You want to feed this data live into the trading system or towards your trader, whether it's a human or a system is kind of arbitrary at this point. And you also might want to use that for historical analysis, kind of to backtest your strategies. The second thing you want is something logically I'm going to call an order entry system. So a trader decides, hey, I want to enter an order now. I want to buy a certain stock at a certain price. They need to have a way to send that to the exchange. These could all be like interconnected. I'm logically thinking about these like different things now. On the same path, you would be able to say modify an order or cancel an order that you've sent into the market. And you would be able to receive what we call executions, whether or not you have traded and how much you have traded if you have. And the third logical thing that's maybe a little bit of an afterthought here for many people if you're not familiar with it is you need to keep track of what you're actually trading. Like what kind of positions you pick up, what kind of accounting and bookkeeping purposes. And you need to upload that to the regulator. As a trading firm, we have a lot of responsibilities to make sure that the heavily regulated industry, we keep up with the compliance standards in that world. I've made these like 3 different boxes, and like you could think of them as 3 different systems. It really depends on how your architecture works out. But I think it's useful to think of them as like 3 big concerns that you need to solve when you're building a trading system. I want to be focusing for the entirety of my talk just on the middle, because that's the part I know best. And I also personally obviously think it's the most interesting, but that is also just because I've been working in it. I think these edges are particularly interesting when we're talking about when it comes to connections to the outside world. And I think that's for 2 reasons. The first reason is when something goes wrong internally, say you have a trading system somewhere internally that starts generating bad orders, everything is kind of fine until they hit the network and go out to the exchange. So in that sense, the order entry system is your last line of defense. That one needs to be working well and needs to be able to catch these issues. Similarly, the second thing is when something goes wrong in the outside world, the exchanges aren't infallible either. The order entry system, or kind of like connections to the exchange, those systems are the first places to notice when things go wrong in that part of the world. First places you want to be alerting on and make sure the rest of the infrastructure knows about it and trading knows about what's going on in the market. So in terms of monitoring technical connectivity and the technical systems, the edges to the external worlds are the places where you have the highest fidelity of signal and the highest risk of options of like making sure you can control what goes out there and doesn't go out there. Now, I talked about orders. What is an order actually? This is an example of an order written in natural language. You can imagine it being in any sort of other kind of digitized form as well. It's an instruction to buy or sell a certain instrument at a certain size at a certain price. And there's different kinds of orders, but I think these are like the 5 components that I kind of want to highlight now, are the basic elements to an order. There's what we call the side, so whether you sell or buy. There's the size, how many of the company or like the instrument you want to buy, so in this case, 1 share. There's what we call the symbol, or you might call it ticker. In this case, a company called JCOM, it's a Japanese company, at a price of 600,000 and then the currency yen. Imagine getting any of these wrong. For some reason, your system flips buy and sell. You get the encoding wrong on the wire. That's suddenly a very different order. If you start executing this in a hot loop, for example, because you're expecting your position to decrement, then you start accumulating lots and lots of bad trades. Or imagine you mess up the currency you write down. Instead of like Japanese yen, you're trading US dollars. You put down, or you're trading in this size. Suddenly your price is off by a factor of 20 plus. These are real things that we think about when we're designing these edge systems to make sure that encoding is really solid. Now, let me tell you another story that I think is really interesting. In December of 2005, Thursday, December 8th, 2005, a trader at one of Japan's largest brokerage firms tried to send exactly this order to the Tokyo Stock Exchange. Unfortunately, they made a typo. Instead of sending this instruction, they sent this instruction. That's a big difference from selling one share at 600,000 yen. They instructed to sell 600,000 shares at a price of 1 yen. Off the back of this one typo, the firm would ultimately lose over 27 billion yen, which is about $223 million at the time. The Nikkei 225 stock index, which is kind of equivalent to the S&P 500 here, dropped almost 2% based on this one order. Worse though, the company or the trader, they tried to cancel that order, but couldn't. And not because of fault in their own system, but because of a fault in the system of the Tokyo Stock Exchange that didn't allow them to cancel that trade in time. There was some litigation around that, and ultimately the company in question here was awarded like $10 billion yen in compensation. However, they were trying to claim for $40 billion yen in damages, so they got maybe like a quarter back of that. The damage is done, though, to the market. So a couple of takeaways I want to highlight from this particular story. Again, very real. You can look it up. I'll put some links on there as well. I find these incidents fascinating. Each order matters. Like things like this is a pretty extreme example, and that doesn't happen every day, but it has happened. So each order matters in practice. And the more subtle thing, which I think is actually more interesting, is that issues on the exchange side in the outside world do impact your own ability to trade. I think these incidents are always interesting. They're highlighting challenges and motivate improvements internally for us or in general. We sometimes refer to this as incident-driven development. I've heard about that like someplace in the outside world. I think it's a great way to frame this. I should also probably, and I will not in the talk about some internal incidents, but obviously they are like secret. However, if you find me after the talk at our booth, I will maybe talk about some and also have couple of interesting stories. There's a couple of good ones going through the Financial Times in the last few months of people doing similar mistakes and actually losing a bunch of money. Not to this extent, though. So let's look at more technical issues and start going a bit deeper there. And I would roughly divide these things into two categories. For one, there's bugs. An error in an order, like we just saw, can turn immediately into a catastrophic loss, or at least very large losses. And more importantly, in automated trading, small errors rack up losses really, really quickly, much, much faster than any human could ever do. The other part we haven't talked about yet are outages. Bugs can lead to outages. In the response to bugs, what we might do is we might want to shut off trading. We want to cause an outage. Now, what are the repercussions of an outage in this industry? One thing you might think about is that the number one thing that's happened is we're opportunity cost. It's trading, we're doing the trading with our own capital. If we're down, we're just losing opportunity cost. I'll say that in itself is very bad, but it's actually not the only thing. There's a couple other things that are interesting. Outages lead to relationship harm. There are people in the industry that rely on us being up. We have agreements with the exchanges, with institutional counterparties that expect us to be there to trade with us. If we are down and we sometimes say, we can't do this trade with you when you most need us, they're going to go to a competitor and they're not going to come back until we've proven ourselves or our competitor screws up. That sort of relationship harm is pretty real and has a material impact. So outages in that world do have an active cost in that situation. For similar reasons, outages are also a regulatory concern. When we go down, we are a pretty large company, that puts strain on the system as a whole. The regulators will come after us, and in the best case, They will ask us to really clearly identify why we went down, and they will not do more than that. However, if we really screwed up, or we screw up consistently, they will put extra scrutiny on us, they will fine us, and they might ban us from trading until we kind of prove that we are reliable again. Something about regulatory concerns is that we trade globally, so they're different in every market. It's very different in the US from Europe, from any of the Asian markets, which makes actually is a very interesting systems engineering problem to be aware of what these different concerns are. Another thing is that stopping trading in itself can be costly and unsafe. Your trading strategy might have picked up a number of positions, let's say a large position in a particular company, under the assumption that within a few hours or minutes, they will be able to hedge their exposure. They'll be able to do trades in the opposite direction. If they are not able to do that because we are down, that actively increases our risk and actively costs the company money. So in that sense, it can be unsafe to shut things down. It can be unsafe to shut things down in the first place from your own perspective. And something else related maybe to the night incident I want to highlight is, kind of relates to both of these, is that when things are very busy in the markets, when there's a lot of trading going on, when the load on our systems is high, the high impact and high risk scenarios correlate with high load on your systems, which kind of has a positive, either doubly positive effect or a negative feedback loop. So if things go down in those situations, they are more likely to go down because your system load is higher, and they are more costly because you have larger positions out in the market, because the trading is more valuable, and because your services are more needed. Now I want to talk a little bit more about trading and the domain to give a couple of insights of how it might be different from what happens at other kind of tech companies when you think about the impact of when things go down. One thing I want to talk about is the time dependence of trading. So one thing that's great in a way is that markets close. So the New York Stock Exchange opens at 9:30 in the morning Eastern and closes around 4-ish. Around that time, there's no trading happening on the stock exchange. It's closed. Our systems for that particular stock exchange, for example, need to not be running, don't have to be running. We think of this kind of part before in the open morning as impact-free buffer zone. If your system goes down at 8 a.m., that's fine. You have an hour and a half kind of to solve it. However, it also means that there are particular times that are particularly valuable. That's the open at 9:30 and the close in the afternoon. If you're down during the open, which is the first time a trade hits your system, which means also is in some sense the highest likelihood for things to happen, for you the first time to notice an actual issue, that is the second most valuable time of the day. So you really care about knowing that you're up by the open. Similarly for the close, the risk is a little bit lower, but you can sense from this also how the load in your system is kind of evolving. You will need to know over the course of the day whether or not your systems will be able to handle the close, and you need to optimize for that. This picture is true in a number of markets, and it's starting to become more of a lie. There are derivatives exchanges that are open longer. There are crypto exchanges that are open kind of 24/7. Stock exchanges behave this way, and there's currently not a huge amount of momentum to change that. There's a little bit, but not a huge amount. We do also have offices in different places, so when we trade in Asia, our Asian offices can take care of that. But I think the time dependence is really true. You see that when people come into the office of our other firms, that are other people that are trading, that is around the time around the open. That is when things start to get busy. The second thing I'll talk about is kind of fine-tuning your technology. My favorite example, because it's very illustrative, is we call about co-location. So for those of you who don't know, co-location means that we try to deploy our own infrastructure as close as possible to the infrastructure of our trading partners in this sense. In this case, let's say an exchange. Why does it matter? Why do meters, or let's say hundreds of meters matter? Why do you want to be in the data center closest to the exchange? Why does it matter that you want to be in the server rack, ideally right next to the rack of the exchange, and have the smallest cable between from your switch to the switch of the exchange? When you think about it, light is pretty fast. But also nanoseconds are really, really short. Like this, on a light for travel this distance, takes about 3 nanoseconds. Now, when you think about like modern CPUs, in 3 nanoseconds, you can get like off-the-back like envelope calculation that you can, I don't know, squeeze in like 7, 8 instructions in like a very stock like CPU, not even optimized. And when you use like hardware like FPGAs and ASICs, you can squeeze in a lot more. There's a lot of things you can do in that time. So suddenly this matters in a highly speed competitive market. This doesn't matter for all things that we do, but it matters for a good number of them. This also assumes, by the way, like light speed in the vacuum. In fiber, light travels like about 30% slower. So all of these numbers, I'm gonna up them by another 30%. But these are actual calculations we do. This matters for our production engineering efforts because you can't just say, here's the system deployed in the cloud. Find me a thing that has this much memory, this much CPU available, and go find me a server for it. You have more constraints on it, and you really care that your systems and your hardware is deployed, or your systems are deployed on the hardware that has certain locality, for example. They're close to each other. This optimization is like relatively hard to do with stock software. So in practice, we build a lot of things in-house for these particular high-performance cases, how we deploy our systems onto this customized hardware as well. Again, this is like kind of a very explicit example, and this is true. In many other cases, it doesn't matter. But a lot of the technology is fine-tuned with very much custom hardware. To illustrate a little bit why we build a lot of things in-house. And the third thing is, trading is really complicated. Finance is really complicated. I've learned that over the 7 years. I didn't know anything before. It's complicated for a lot of good reasons and for a lot of historical reasons. And it's really fascinating. If you're kind of interested in that, I can talk a bit more about it after the talk. But when you trade all these different asset classes that have different concerns about what kind of data you need to trade, you trade in different markets. Trading in, let's say, Hong Kong is exceptionally different from trading in the US than from trading in Europe, for example. And you need to know all these intricate details when you're trying to decide how to respond to an incident, to something going wrong, to something going down. Another thing that's interesting is our users, because of that, are also generally experts. They will ask very detailed questions. We can leverage them in how we resolve an incident. So there's a very tight feedback loop between our production support and our trading users. Your response to an incident really depends heavily on the context of the trading you're in. Oftentimes, it's not just something is 0 to 100% down versus up. You oftentimes have mitigations, right? You can say, okay, like everything here is down, but I have a mitigation that brings these 40% back up, or these 20%, or these 50%. And sometimes getting these 20% up realizes 90% of the value. Knowing that in your, let's say, L1 support, for example, just cuts down on the time of how quickly you can respond to an incident. And when we talk about an industry where you can easily lose $10 million per minute, this time matters. Monitoring. We've talked a bit about why it's complicated. How do we actually go and monitor our systems? One thing I want to say immediately, which kind of was inspired by a talk I saw earlier this week here, is that monitoring in itself is not optional. I saw a talk the other day. It was kind of like more general, also engineering talk, talking about, okay, here are like 2 classes of systems. One are like the core workload systems, and other ones are like kind of like best effort, nice to have systems. And one of them that was in that classification was like a monitoring system, was a metric system. I was kind of confused by that. We would never run. We would never ever run without visibility of our trading. You cannot leave a trading system unattended. We'll have traders watching trading at all times, and we have engineers watching trading at all times. We'll take down all of our trading systems. It's not exactly true. We take down most of our trading systems before we will take our monitoring. For exactly the reasons what we've talked about in the case of like Knight Capital, we're really scared of that happening to us. So there are two ways in which we, I think, distinguish monitoring. For one, there's the tech systems monitoring, what we call technical health. Is our software and hardware running as expected? Are we going to be running out of memory? Classic things. Are there any technical issues? Are there issues on the network? Is latency higher? Is latency unexpected? Are there some certain packet drops? These are kind of like clear technical issues. Also, are our systems able to send orders in the way that we expect? Our traders want to send an order. Are we able to do that? Are there issues on the connection to the exchange? Because on their end, on our end. Are we observing any of these things? Something we call like technical health. It's a little bit removed from the more of the business concerns. It's still related, but that's one part. And the second part is trading impact monitoring. Are our systems actually sending the orders that we want to send? What kind of P&L, profit and loss, are we accumulating over time? Are we actually losing money based on those trades? How are the markets responding to the trading that we're doing? The left-hand side is generally done by engineers, and the right-hand side is more done by the traders itself. But they're both crucial in order to assess whether or not you are about to make a big mistake. I'm going to be primarily talking now about the left side, because I only have 35 minutes. So let's talk very quickly about the basic message flow, just to recap a little bit where we're at before I talk about what kind of monitoring we have in place. In an order entry system, there's roughly four or five-ish things that can happen. You want to send orders, that's things we send outside. You want to be able to cancel your orders, very important. You want to be able to receive what we call like executions, and executions can include like acknowledgements, so our order has made it to the market, rejects, or order was invalid, or we call like fills, so we have traded in some way. Now, what kind of monitoring would you want to put on top of that? Let's start with thinking about like SLO-based monitoring. Very clearly, like the first approach you might want to take. Let's say we define an SLO like the uptime of our order entry service should be above 99.99%, or however many nines you want to add on the back of that. That's very easy to do, very easy to measure. There's a problem with that relates to kind of the impact of outages in general, is that any downtime immediately requires attention. If it's down for however a fraction of a percent, that always is an incident. Any singular downtime can have the scrutiny of a regulator, of relationship harm. It will require us to reach out to the other technical side. Having a kind of metric on uptime is not good enough. So maybe you want to go more fine granular. Maybe you want to say the error rate should be below a certain percentage, say like the amount of rejects that we see. This is like better because sometimes rejects are kind of like a little bit expected, and you do want to notice when they're going significantly high. However, in general, it's similar here to loop back to the example of the Japanese trading incident that I talked about. Any order can be critical to cancel or send at any given time. So we will want to make sure that if there are issues on and requests that we send are getting rejected by the exchange, that we look into this, that immediately we know, is this something that is benign or something that will impact our ability when we have to send a critical order or cancel a critical order, that we will be prepared to solve this. And the third thing is, maybe we want to put like something on latency. Like the P99 latency of our system should be below a certain threshold. And yes, that's actually something that we do. Increased latency on like in the different buckets or an average latency is oftentimes a leading indicator of like issues. Your network is degrading. Maybe there's going to be soon like a fault, or I don't know, literally happen like a squirrel chewed through a cable between us and an exchange. You might have to see that issue, and then you have to go through a backup path. These are things that we see. However, even here, tail latency, so kind of the very extreme, matters as well. But if we go back to thinking about how fast we sometimes have to be in sending orders because of the speed nature of the trading, that means our trading strategies are built on top of the assumption that we can trade within, let's say, a microsecond. So the tail latency matters, and you might start accumulating losses as well if that one starts to go up. Now, what do we do instead? We rely a lot more for live trading monitoring on event-based alerts. The predicate on making this useful is that your event-based alerts are high quality, not toily, not noisy, and always actionable. That is a high bar to hit, and we don't always hit it, to be very clear. But they give you a lot of benefits. If you are able for your trading system to immediately say, here's an unexpected state I've reached, here's an error, you'll be able to raise an alert directly to your support. That's kind of like how it works for us. It gives you higher detail of what is going on. It can give you a direct link to the call site, like where the error has been raised. So you can just basically click on the alert and it takes you to the code where the issue has been raised. But it also makes these alerts kind of like harder to change. Like when something is toily, it actually is kind of like hard to change it a little bit. You have to go deep into the system. And they're more easy to be noisy. However, we do, for live trading systems, primarily rely on this kind of alert. We believe it gives us the highest ability to react quickly to incidents. We do look at metrics-based alerts for kind of the SLOs just I mentioned, for long-term health, how is the latency developing over time, how are our systems running at any given time, is the memory utilization in the right ballpark. All of these things we do still use, but they're less used for, oh, this is now an immediate incident for trading that we just look into. It is useful if you see kind of your memory consumption creeping up above a certain point and you're worried that you will run out of memory. Now, what does a support shift actually look like? Let's say you're a New York engineer supporting order flow connections to our exchange. The US exchanges trade from 9:30 to 4 p.m., so kind of like that's the core trading hours. You want to be in like a little bit before then. So you show up at 9 a.m., you catch up with London. We have like a follow the sun rotation, so no one's generally on like duty when you're outside out of the office. We split the support shifts into two kind of like different buckets from 9 a.m. to 1 p.m., 1 p.m. to 5 p.m. Usually that way around because like morning is shorter because in the morning more things are happening when systems start up. And the afternoon is like usually a little bit quieter. And people on support like roughly like once every 4 to 6 weeks. People do a lot of project work, even like during support or during the support shifts because it's not always incident mode. And this is pretty typical. It's not, the things I'm going to talk about now are not that unique to us. I think it's pretty common across the industry. This is where we follow a lot more the general, where it feels like a trading company, like a tech company, how we work. So when you run into an incident, first thing you want to do is like what exactly is happening, how much trading is impacted, is it this particular desk, is it that particular instrument, is it that particular market? You want to narrow that down as much as you can. You want to assess how bad it is, how much money are we losing actually. You need to loop in the traders to do that calculation oftentimes as well, but the more context you have already is good. You go and find SMEs if you're not able to resolve it. You ask for help. You're very loud about what you're doing, because any action you might take itself can be, as I mentioned, unsafe. So you'd want to try to be loud about it. And then you go and fix it. And you like rinse and repeat until you're happy. Very, very, very standard. I think this is like something everyone here is probably familiar with. So going through a very specific example real quick. This might really happen. It's like a bit, I made this up now, but it's something I've done like for sure. So let's say 9:30, market's open. Now we're starting to see rejects only on a particular exchange, say on NASDAQ. We conclude from that, the impact is limited to that exchange. When looking more detailed as these rejects that we're seeing, we see that they're all coming from one particular trading system on a subset of US ETFs that we're trading. We talk to the desk, so our traders are organized in kind of like trading desks. That particular desk, they confirm they are seeing that none of their orders are going out. It's bad, and it's like, look, it's particular to their system. We now proactively halt trading from this system. We say you can't send anything out anymore, so that no further messages are going out. It is not going to be such that now these rejects that are going out could cause our network queue, could congest it. It could cause issues on the exchange side. We do want to proactively halt this so nothing scary is happening until we really know what's happening and we can mitigate the issue. We also broadcast this issue to the rest of the world. So we have kind of an internal broadcasting system that'll be very loud. All of our trading users will see it. Because the system uses like shared components, so something might be going on in other parts. We notice, we're looking a little deeper, like 8 minutes in now, the system in question was recently rolled to a new version. The message format was changed. We conclude it's kind of like the solution here is to roll back the system from talking to the SMEs. And let's say 5 minutes later, we're back online. So between us like seeing the incident and responding by like first of all halting trading, mitigate what's happening, so it's not being much worse, took like 4 minutes, and then to being resolving it took like another like 9 minutes. This is like fabricated, I said, but it's pretty I think, pretty good example of what we might actually do. And then you do the post-mortem analysis. You go and say, what was the overall cost? How much money did we actually lose? How did this change go into production? Could we have noticed the issue sooner, kind of like before the open with canaries? And why did it take 5 minutes to roll back the system that's really long? These are sort of things that you might like to look into. This is one of my favorites I kind of want to highlight as well. So something probably went wrong. Someone made a mistake somewhere. Someone shipped some code that was bad. We strongly believe when you analyze what went wrong, so talking about blameless postmortems as well, we want to have a culture where hiding mistakes, no one does that. It's not something someone should do. Hiding mistakes is much, much, much worse than making mistakes. The history of finance is littered with examples of people that are so-called rogue traders. Look at what rogue traders are, fascinating. People who've made mistakes and then try to cover up their trading mistakes by then doubling down on more risky trades and accumulating losses and losses and losses, ultimately like either ranking up a huge amount of losses and in some cases bankrupting whole companies. It's important for us that we do not run into this pattern. When you're making a mistake, it should be very important that you can put your hand up, oh, I fucked up, let's fix it together. Also, like 9 out of 10 times, and probably more than that, when something really bad goes wrong, it's not a single person that made a mistake. It's more people that made a mistake. It's a procedural error in some sense, like something was wrong because you were allowed to make them, like you could make that mistake, that in itself is kind of wrong. But we drill this into people really hard and we practice it. There are a few incidents that I can remember where I have like, I don't know, within like the first like 3 months I joined, I made a mistake and I was really scared. I felt really good when people talked about it like in an open way. No one ever pointed fingers. And this is why. Because hiding mistakes is much, much more costly than making mistakes. Let's quickly run through before I wrap up about some projects and some tools that we would be building in like production engineering efforts. You would have, say, like a connectivity monitor. That's a pretty central part. So like my bad Figma mock-ups, please excuse them. Couldn't like get a screenshot of our real systems. But you might want to be able at a glance to see what the status of your connections to exchanges and trading partners are. You want to be able to see how much money you're trading. Is there like any sort of, maybe you care about the derivative here actually more than you care about the absolute value. Like is there any variation from the last few days? How does it compare? Is trading more busy, less busy? Why is that the case? Are your message rates at a reasonable level? How is the latency looking against your expectations? And even more importantly, you want to take actions as well from this UI. You want to be able to say, connect, disconnect, halt things as well. We'll talk about that in a second. So as in like turn off trading to this particular exchange, for example, if there's a systematic issue. Looking at logs in detail, having good views about that is really important for a quick response. So we have a lot of people working on refining this shape of tool to allow us to monitor our connections in depth. Another thing people might do is performance benchmarking. So care about having your systems operating at like an expected performance. You have some sort of requirements. This particular operation should take this long or that long. And we've built tools to automatically run on custom hardware because a lot of what we deploy is on custom hardware. To define arbitrary tests on custom hardware and running them on our infrastructure. That's a pretty big project that we work on and we use across the firm. And another thing might be this kind of like global halting service. So what kind of things are currently enabled or disabled for trading? And much, much more importantly, why? So you know when a trader asks you, why can't I send my orders? This is the reason. And maybe you have some link to kind of more details about it. And you want to be able to control this from this UI very efficiently. So wrapping up at this point, in this business where high-value decisions are made in split seconds, the ability for our support to react correctly and quickly is absolutely crucial. We do that by using actionable event-based alerts to enable quick response, high-detail alerts that give you as much information as you need, And really, they must be actionable every time. We treat monitoring systems as critical, and they need to be the most robust system in our pipeline. We're happier in general with our trading systems like going down first. If our monitoring systems crash, we will take down a lot of our trading as a first response. Never fly blind. Our support needs business knowledge to make high-quality decisions. You need to give people the information that they need in order to say, this is that important. Escalating takes time. You do need to escalate for a lot of things, but empower them with more knowledge that they can make more decisions in detail quickly. And in general, empower your production engineers or your support to take action in an emergency. Don't make them just be, oh, I like escalate, always escalation points. No, they should be empowered to say, I feel scared about this, I'm going to make this decision now. And that needs to be a thing that is okay for them to do. For more details, this is all I'm going to talk about now. For more details, we have a podcast. Just like a good hour, Signals and Threads, the podcast called, talks about production engineering as well. It's called Solving Puzzles in Production. Highly recommend listening to it. I listened to it on my flight here. There's also other things on there. I kind of want to plug that podcast before I head off. And otherwise, also we have a booth out there. So if you want to come by and chat for more about more incidents, I will be around, as will a few of my colleagues as well. Thank you.